Welcome back to Level Up, a podcast for you because you don't know what you don't know. I'm John Cale, your host. Welcome you back to episode 2 of my credit score, What the Heck? So if you joined us in the first episode, you learned probably a lot of information about credit. I tried to lay the foundation for you so we could give you some stuff. If I would have tried to give you what I'm going to give you today in the first episode ahead of time, you would have said, well, I don't understand. So that's why I did this in 2 episodes, so that you could understand and it flows. And hopefully after this episode, you will maybe not be an expert in credit and understanding it, but you will have a good understanding, period, of what it means and how to manage your own life and credit around yourself. Okay? So we're going to continue that discussion today. I would urge you, as you know, if you watched the first episode, there was a lot of information. And I would urge you to maybe get some paper out, or if you've got your phone, maybe to make some notes in a text that you can send yourself or wherever you want to do it, so that you have this information that's pertinent to you after we're finished with this episode, okay? So I hope you've looked at your situation since the last episode and looked at your life. I did challenge you to consider going and looking at Credit Karma and signing up. It's a free service for you that will show you your credit score. We talked about the fact that it may be a little higher than the credit bureaus, but it is very realistic for you. It will show you what your scores are. It will show you how your history has been, and there will be specific offers on that platform that are put together for you if you're interested in that. So I hope you've investigated some things and taken the word that I gave you of applying this information to your life. Again, if you don't take the information you're given, you can listen to it all you want, but if you don't do it, it's not going to matter, right? You can go and get trained on how to do something, a sport, whatever, a skill, and you can sit there and you can watch somebody do it, and you can get up and you can leave and go home, and you're going to be the same person if you don't figure out how to do what they did and put into place what they were teaching you. So that's all we're asking here, right? Put forth some effort into yourself, right? Do something to help you. That's the whole purpose of this podcast, okay? So the last time we talked about what is credit, we talked about what the credit bureaus are, right? Experian, TransUnion, Equifax, the 3 main credit bureaus that have all the data. When we talked about what is credit, we talked about the fact that it's a trust relationship. It's between a lender, someone who wants to give you money or a service or a product based on trusting that you're going to pay back, and their trust factor is your credit score, right? So that's what credit is. And we talked about the bureaus. We talked about the scores. What's a good score? What's a bad score, right? And then we talked about the types of credit, right? Revolving. We talked about installments. We talked about how revolving and credit cards and installments would be a car, right? These are the different kinds of credits that you can get when we talk about credit from a high level. So today, we're going to spend a short time talking about how to get credit. I didn't want to go through this without at least realizing that some of our audience out there may be going, hey, how do I get credit? I'm young. I don't even know where to start. So I wanted to give you some pointers, right? I want you to understand how you can begin credit early and get ahead of the game on other people, okay? I want to give you the formulas by which the credit bureaus determine what your score is. We went over the scores last time, but I want to go over how they will determine your score. And when you understand the rules of the game, you'll be able to take that and apply it to your life and make sense out of your credit score, okay? We're going to give you some advice on how to stay out of trouble, and we're going to share some products with you. That's what we're going to cover today, okay? Here's my fact. Here's my disclaimer, all right? I got to tell you, I am not a financial advisor or a certified planner of any type, okay? I'm a guy who has lived what I'm telling you and experienced things around credit that I want to share with you, right? Just because I want to help you out. You can take and do with what I share as you want, okay? You can walk away and go, you're a whack job. You can say, hey, this makes sense. But that's my disclaimer, okay? I'm just trying to help you and add value to your life, because this is outside of the spiritual decision that we've talked about over some of the past episodes in your life and your eternity, right? This is one of the biggest things you're going to deal with on this planet, is learning how to manage your money and the things that you can acquire and not acquire based on credit. It is huge, and it can make or break your life, okay? So I did mention to you last time that a lot of people have told me, I wish someone would have shared this. I wish people would have told me about it. I wish they'd have taught me it in school. because I've had to learn the hard way and walk through some really difficult stuff and learn the hard way rather than listening and getting direction from someone. So our word for today is knowledge, right? Very simple. It's knowledge. Here's some of the worst feelings that you might ever have, right? Imagine yourself getting to a point where you have been paying your bills. You've now got a good job. Maybe you didn't. Maybe you lost your job, and maybe you went through a rough patch. Maybe you went through a divorce. Maybe, whatever. All these different things that could have affected your credit. But now your life is back together. And you go to the dealership and you found this car and you zero in on it and everything's cool. And you sit down and you're like, yeah, here's the deal. And you're good with the manager and you're like, done deal. You sign the paper and say, yep, if you guys do this, I'm in. And they come back and go, we're good. And so now they come back to you, you maybe leave or you're there for a bit and they're like, hey, I'm really sorry. I can't get anybody to give you a loan on the car. And you imagine that feeling, right? You are completely devastated that you can't buy a car. You're working hard. You got a good job. Everything's cool, but you can't get the car financed. Why? Because your credit score is a problem. Your credit report is a problem, and you don't understand why. You're just frustrated beyond belief, right? Imagine you look for a home and you find the perfect place for your family, right? And you're ready to go. You have the money. And they won't approve you for a loan so that you can buy a house. And you lose the house, and now you have to live in an apartment for longer, right? These are reality situations that people face with credit every day. And these are the kind of things that I want to give you the information so that you can be smart ahead of the game, and that won't have to happen to you, right? And again, it doesn't matter how frustrated you get. It doesn't matter how much you jump up and down and scream or throw a fit. It doesn't matter because it's an absolute. These are rules and guidelines in place around this industry, and you have to play by the rules. There's no special deals here, right? You have to play by the rules. So again, make or break your life depending on how you look at this subject matter and take advice on how to proceed, okay? Remember, it's a trust-based relationship, right? Where they're going to give you something based on that score, okay? We talked just briefly, if you remember last time, I shared with you, if you lined up pennies end to end, the amount of debt we have in the United States right now in all consumer debt is $17.7 trillion. And to put that number into perspective, if you missed episode 1, we could take pennies and put them up against each other, and it would create enough miles that you could have pennies from Earth to the sun and back from the sun to Earth and still have 15 million miles of pennies lined up against each other. So that gives you a perspective of how much money is in this whole credit scenario, $17.7 trillion in our country right now. So this is a big game, right? Big game. And lots of people in our economy, lots of companies, banks, financial institutions are all into this thing very deeply, right? Because it's a lot of money, all right? So what is a credit score? We talked about that. The number that's assigned to you. Remember, we talked about a good score. For those of you who missed it, 670 to 739 is a good score. That gives you the ability. If your score 670 to 739, that gives you the ability to get anything within reason that you would like, right? You want to buy a boat, you want to get a car, whatever you might want to get. You want to get a roof on your house, you want to buy a house. I mean, to a certain point, if you try and buy all of those things plus 5 more, they're going to tell you no, because they're going to say it's too much money a month and it doesn't fit the formula, right? But if you have a good score, you're going to have the ability to do what you want to do there in your life. And a very good score is the 740 to 799, right? So again, same great things. And at that point, from 740 all the way over 800, you get into the excellent realm of score, which the positive is people are coming handing you money at a very low rate. The negative thing is they're handing you money at a very low rate, and you have to be able to say, no, I don't want to buy a boat because I already have a trailer and a car and a house, and then the boat's going to push me over the edge. Okay, so you have to learn to manage it and be a little more mature with it. So let's talk today for a few moments about how I get credit. I wanted to just be able to talk about this. If you have kids, and you may not even know this if you're a parent, and you have kids and you want to help them out with getting good credit so that they're not coming to you going, hey, will you sign for my car, man, so I can get my first car? Okay. Co-signing is not something you want to do, by the way. Okay. People are going to hate me for that, but I'm just telling you, when you co-sign for a loan, here's the problem. It shows on your credit. So if I'm dad and I sign for my son Denton's car, it now goes on my credit that I have a car worth $20,000 and this payment every month. Even though it's his car and he's paying the money for the payment, it's on my credit, which means if I want to go get a boat, they might look at me and go, well, I can't lend you for the boat because you got this car. So co-signing for people, be very careful. Okay. Again, I'm not a financial planner, but I am telling you that's reality. Okay. I've been down that road and understood it. So you got to be really careful. Okay. So number one, how do I get credit? How do I build credit if I've blown it? If I've blown my life up, how can I restart? Okay. Number one, you can apply for a secure credit card. That's one way. So you can go to a bank. If you have absolutely no credit or you have blown up your credit before, you can go to a bank and apply for a secure credit card. Basically what you do is you say, hey, here's $200, $500. Put this in an account. They'll put it in an account in the bank and they'll issue you a credit card and you can use that credit card against the money that you just put into the account. So it's secured, right? If you decide you're not going to pay it, they just take the money out of the account. So you do that, you use the credit card, you pay it back, you use the credit card, you pay it back, and you start to build credit with the bank. They start reporting on you, building trust with you, right? And it will build credit with all your bureaus, okay? Some of the banks, just so you know, have credit cards that are secured credit cards, like I just talked about. But after 6 months or a year of you doing that, they convert to what's called an unsecured card, which now means that the $500 that you put in, they release the hold on it. And now after 6 months to a year, if you've been making your payment, they don't take your money. They just give you a credit limit that you can use. And then over time, as you pay that back, you have your money. They don't hold your money anymore, but they'll then raise your limit. Maybe they'll raise it to $1,000 or $1,500 for an emergency, right? So that's one way that you could rebuild credit. Here's another way if you're young, right? This is what I used to tell my students when I was teaching. Become an authorized user on someone else's card. So Joey, who's listening today, you're going to go to mom and dad and let's presume number one, your mom and dad have credit card. Number two, that they pay their bills on time and their credit's good. Okay. You're going to say, Mom, Dad, would you guys get me a credit card with my name on it? So maybe mom and dad have Chase cards and mom and dad, you say, would you get me a Chase card with my name on it? Joey, right? Joey, whatever, Smith on this card. And you get the card, mom and dad get the card for you. They open the account and they don't give you the card, or maybe they do. It's up to them. But the point is you don't even have to use the card because that account now is tied to mom and dad's account. And all of a sudden it will start to report credit on you, even though you don't have credit. Okay. And I can tell you this really works. With my daughter, I did this when she was in high school. And when she graduated high school and went into college, her credit was so good because I had gotten her a card and she got the benefit of having that card, and our card payment history was good. Our credit history was good, that she would have been able to purchase a brand new Honda Civic Si on her own, working part-time and being a college student, because her credit was that good. So this is a really good one for parents. If you want to help your kids out and teach them responsibility about credit, get a card with their name, give it to them if you want or don't. Maybe give it to them, put a limit on it, or let them use the card to get gas or whatever. And it will build their credit and be very, very helpful for them as they grow up, okay? There's also a thing called a credit bureau loan, which is very interesting. This is offered a lot of time by credit unions or financial technology companies like Self, Credit Strong, or MoneyLion. I'm going to say those again, right? Self, Credit Strong, or MoneyLion. All right, these are called credit builder loans, right? You borrow a small amount of money and it's held in a savings account. And then you make your payments that are monthly on that money, and the loan is paid off, and you get the money and a stronger credit history. Okay. So there are organizations that will help you. Many times there are people who prefer to work with a credit union because the guidelines and restrictions federally in our government, in our country, and all around the financial industry, in some cases, I don't know all of the specifics, but working with credit unions sometimes gives you more flexibility. They can be more flexible sometimes than some of the main banks. So if you are a part of a credit union or work for a group that's attached to a credit union, you may want to look into that, okay? Credit unions call their customers members. They don't call them customers or consumers. They call them members, where banks will call them a customer or a consumer, okay? So there's 3 different ways for you to look at the potential of how you can start some credit, okay? Now let's get to some really good stuff, which I really want to, this is the meat of this episode, which is how does this work, right? The 3 credit bureaus are assigning you a credit score, right? Again, you're going out to get a car. They make an inquiry. The credit score comes back at 680, and the bank says, boom, either we're going to give you a loan or we're not, right? It's that simple. It's based on that score. And many times it used to be in days past, right? Where, you got $1 million in the bank, right? And you're trying to get something and your score is low. Well, you got $1 million in the bank. I'm going to lend you $20,000 for the car. No problem. Not so much anymore. They don't look at what you have or what your assets are. They really, really drive based on your score. Because it's quick, it's efficient. I mean, there's so many places, many of you on watching the podcast, you can go online and fill out a couple things online in a form, and all of a sudden, boom, yeah, you got it. Here you go. Here's your card, or here's the amount we'll loan you. You don't even have a body involved. Nobody's there, right? It's all digital. So that's important for you now to understand how this works. So I want you to think about this. 100% of your credit score. Okay, so we're going to take, let's just say we're going to take a piece of pie, right? A circle. Just think of a circle in your head, all right? And we're going to cut it up like a pie. And I'm going to tell you what those pieces of pie are that make that whole piece, which is your score that they spit out. So when you understand the pieces to it, you're going to see value in your life. So number one of the first things they judge to give you a score is your payment history, okay? Here's the kicker. It's only a piece of 35% of that pie. It's a 35% piece. It's not all of it. They weight it, and it's 35%, how you make your payments, right? It is the most important factor, okay? It is the most important factor, but it's only a piece of it. It's not all of it, okay? It includes, right, what's included in me paying on time. It includes late payments or missed payments, okay? So I want you to understand this about the credit bureau. This is really huge for you to understand. Number one, if your payment is due on the 10th of the month and you pay it on the 12th, it's late, okay? Now, if you have a particular type of loan like a mortgage, right, or some other types of loans, a car loan, they have a 10-day grace period, okay? So if the car payment or the mortgage payment's due on the 10th of the month, right, that means that you have till the 20th to pay it, and they won't charge you a late fee, and you're not late, okay? They give you what's called a grace period, okay? You got to make sure that the loans you have that. Don't just presume because you heard it here. Remember, I'm not an expert, I'm not a financial planner. I'm not telling you everybody does it. I'm telling you make sure the loans you get do it, okay? But many of them, cars and homes, give you a 10-day grace period, okay? So that's one thing. That's what that gives you a grace period and you're not late. But if you go past the period of time, grace or the payment is due on the 10th. Let's just say it's the 10th and there's no grace period. If you pay it after the 10th, you're going to get a late fee, right? $20, $30. They're going to add that to your bill, all right? And it's late. That does not mean they're going to report it to the credit bureau, okay? You need to understand this. In order for the lender to report your loan or your situation to the credit bureau, it has to be 30 days late. So if it's due on the 10th of June and you pay it on the 8th of July, it's late. You're going to pay the lender a late fee, but it's not going to show on your credit bureau as late because it has to be at least 30 days past due for them to report it to the bureau and for it to hit your credit score. Okay? Very important thing. So in the first bucket, payment history, which is 35% of the pie, late, what's under payment history is your late and missed payments, bankruptcies, right? If you've blown your life up, that's the mother of blow-ups. That's the big minefield, right? You bought too much stuff. You don't make enough money. I can't make it. I'm eating ramen noodles every night. I don't know what I'm going to do. Mac and cheese, ramen all the time. I'm in trouble, and you're going to go see a bankruptcy attorney, and you're probably going to have to pull the plug and file bankruptcy. Okay. Now, you do not ever want to be there. I have been there. And there are basically two types of bankruptcies. A number 7, which is a liquidation, and a number 13, which is a wage earner's bankruptcy. Okay. What's that mean? A number 7 means that you're going to get rid of everything you have. You're going to lose your cars. You're going to lose your house. You're going to lose your credit cards. You're going to lose anything that you bought that has value. They're going to even take your furniture out of your house and sell it. The bankruptcy trustee will take the furniture out of your house and sell it to raise money to pay your debts. Okay. I mean, I'm telling you, this is very real. So you cannot file a Chapter 7 now without qualifying. You go see a bankruptcy attorney and say, I'm in trouble. They're going to say, here, you're going to give you this test. And they're going to ask how much you make, and you're going to put all your bills on there, and it's going to spit out a number, and it's going to say, yep, you can qualify or you don't. Now, why are they doing that? Because years ago, back when I was younger, people would go buy a new car, people would go buy new furniture, people would go buy a boat, and then they'd turn around and go file bankruptcy just because. And they'd keep all their stuff, and they wouldn't get liquidated, and there they were, right? Now, bankruptcy is bad because it's the worst possible thing you can do to your credit, right? To jack your credit up. And it puts a big dent in you for a long time. It used to be 7 years that your credit was crap and you wouldn't be able to do anything. I don't think it's like that now. I think you could recover out of a bankruptcy within a couple, 3 years, but it's going to put you in a tough position, okay? So I just want you to understand that bankruptcies are part of the getting reported, right, under missing payments. A 13 bankruptcy, I'm just sharing you a little education here, is a bankruptcy where you say, I need to file bankruptcy. I don't match to do a 7 because I didn't meet the right criteria. But a Chapter 13 is a wage earner's plan in which you say, look, I'm over my head. I can't pay it. And they look at you and they say, okay, well, how much do you make? And here's how much all your bills are. And here's how much they are a month. So here's what we're going to do. We're going to make you pay back all the people who owe you money 50 cents on the dollar. Okay. Based on your situation, you're going to pay the court every single month. We're going to come up with this number. You owe $100,000 to all these people. We're going to only make you pay $50,000 of it back. And we're going to take the $50,000 and divide it by 5 years. Okay. And you're going to pay this much every month until they're paid off. Still a bankruptcy, but you get to keep your stuff. And as long as you're making your payments, it's all cool. Okay. Again, still major ding, shows as a miss on your credit. It's part of the 35% piece of pie. All right. Foreclosures. If you have a house foreclosed, that basically, for those of you who aren't familiar with this verbiage, you buy a house and you don't make your payments. And after a period of time, 6 months, 3 months, you don't make your payments on a house, the bank will foreclose on you. That means they're basically saying, we're going to take the house back out of your name. We're going to get it. We're going to sell it. And we're going to ding your credit. You're screwed. Okay. Charge off and collections. Those are things that can also affect your credit. Will sneak up on you, right? This could be something on your credit report that you don't even know that's there. So pay attention to this, because some hospitals will actually send medical bills to the credit bureau showing that you didn't pay the bill. And you might be having your credit score down and as a missed payment by some company out there working for a hospital trying to recover a bill from a hospital you don't even know is out there on your credit bureau. So you need to watch your credit bureau closely. Some report to credit bureaus, some don't, okay? The biggest thing for you is if you've got medical bills and you can't pay them all off, here's what you should be doing. Make a payment of any type. If you are making an effort to make a payment on a bill with a hospital of any type, they will typically leave you alone because you're making an effort to pay it, okay? And they're not going to screw around with you until you can get it paid off, all right? The second bucket, so remember, that's the first piece of pie, 35% payment history. The second piece they use to come up with your number is the amount that you owe and credit utilization, okay? That's 30% of your score. So between the amount you owe and the utilization of your credit and the first bucket, which was your payment history, you have 65% of the weight in those two pieces of pie on how they come up with your number, okay? So what that means, what the second one means is that it compares your total credit card balances, for example, to the amount you're using, okay? And so the magic number is 30%, okay? And what I mean by that is, let's say that you got credit cards and all of your credit cards limits added up are $10,000. You got $10,000 of credit cards you could use anywhere you want. The banks never want to see you use more than 3,000 of your 10,000. Or if you have $1,000 in credit card availability, they never want to see you use more than 300. Don't ever let the amount you're using go over 30% of what you have available, right? This is a major important factor. If your debt goes over 30% on your open credit, it starts to deteriorate your credit score in this bucket, number 2. Okay. So that's an important number for you to remember. The other thing that I will tell you is don't close your accounts if you pay them off. If you have an account for $2,000 and you pay it off, right? And you're like, I paid it off, I'm going to close it. I did the same thing for years, right? And then I realized and understood that I'm better off to keep the account open. I paid the $2,000 off, but I still have the account open with the $2,000 on it, and I don't use it. What that does is that says to the bank, hey, there's $2,000 that you have available that you didn't use. That drives your total open credit and use down, right? Which impacts your score and makes it go up. So I know this is kind of crazy, but this is true stuff. This is how they figure it out, okay? So that's the second bucket. The third bucket they use is called the length of credit history. That's 15% of your score. That's the third piece of pie. Length of history, right? Considers how old you are. How old is your oldest credit account? So how long have you had credit? 10 years, 2 years, 5 years, 40 years, right? And what's the age of your newest account? How long have you had the newest account on your credit report? And then they look at an average age of all accounts, okay? So you would think, what? Yeah, 15% of your score is based on the length of your credit history, how long you've had it, how many you got, the average time you've had credit, okay? Long credit history, the longer, the older you get, the longer you've had credit, it typically 15% weight will cause your score to bounce up, okay? Along with you having a strong payment track record. The fourth piece of pie is your credit mix. And that's a 10% piece of the pie. Again, weighted, right? It measures the variety of credit accounts that you have. So what they're looking at now is the 10% weight is, well, do you have all credit cards? Or do you have some credit cards? Do you have a Visa card? Do you have a Target card? Do you have a bank card? Do you have a car loan? Do you have a boat loan? Do you own a home, right? Do you have a mortgage? They look at the mix of what you have, cards, loans, home, etc., and assign a weight to that, and it's a 10% piece of pie on your total overall credit score. You'd think, what? Yeah, you got to watch it and make sure you have some diversity. If you have 10 credit cards, okay, and you don't have any installment loans, that could be a problem. That might affect this piece of pie, okay? And then the fifth piece that they put into play is new credit and recent inquiries, okay? New credit and recent inquiries. And you might say, well, what the heck's that mean? It's another 10% piece of the pie, all right? 10% piece of the pie. And the noise you just heard was our producer walking in front of the timer and knocking it on the ground. But it's cool because this is real time. And it's all cool, man. It's all cool. He's got a lot of things going on in the studio today, so it's not a problem at all. I just might as well talk real with you. So anyway, new credit and recent inquiries, 10% piece of the pie, all right? So it reflects, this is important, how often you apply for credit. So if the bureaus show that this past week you applied for credit 10 times, right? That's a flag. Like, why are you applying 10 times at 10 different places? Well, is it because you're shopping for a rate? Is it because all the other 9 places said no and you're trying a 10th one? You see what I'm saying? Like, that's a flag to the lender. That's why it's a 10% weight on your credit bureau, okay? And the number of recent inquiries of where people are inquiring and looking at your credit is also a big deal. Not only applying, but inquiring. So you want to make sure that people are not checking your credit score, what people call a hard check, right? is a hard check is when somebody pulls your credit and looks at the whole picture, where a soft check is they don't really pull it officially. They look kind of at a higher glance. So a soft pull and a hard pull, make sure you watch that, because if you get too many hard pulls in a short period of time, it will hit this piece of pie and it will drive your credit score down. And you're going to be like, why is my score going down? And so now you know, okay? The number of recently opened accounts, you want to make sure that you're opening new accounts, not like every week or anything, but periodically open a new account. Don't put a balance on it, right? And have that new account so they show that, you've got some new stuff going on. It's not just all old stuff on your account. This is all part of that pie, okay? So those are the 5 major areas that make up the 100% pie, okay? Number one is payment history. That's 35% piece. Number 2 is the amount that you owe, your credit utilization, keeping it below 30% on a credit card on the amount you have available. Number 3 is how long you've had credit, 15% of the pie. Number 4, the mix of credit, right? Not all cards, not all loans. You want a good mixture. And number 5, that you don't get too many inquiries where people are taking and pulling your credit all the time, and keep some new accounts. That completes the 100% ball that they look at when they give you your score and the bureaus, okay? So how can we get into trouble with credit, right? It can sneak up on us. It can make a difference in our life. It can sneak up and surprise us, right? So here's some things that can affect and cause you trouble with credit. Number 1, you have good credit. And you'd be like, well, how does that cause me trouble? Again, I have good credit. If you have good credit, you can get lots of credit. You can get lots of stuff. You can get things that you want. You can be an impulse buyer, right? You can be out walking with your girlfriend or significant other, around the mall and look across to the car dealership and be like, man, look at the new BMW. It's so awesome. And we're going to walk over and we're going to look at the BMW. And all of a sudden we find ourselves in the showroom talking to the guy about the BMW. And all of a sudden you're in the BMW driving it. And then you're back to the dealership and you're saying to the significant other, or your girlfriend, your wife, whatever, hey, this is the coolest car in the world. I mean, I have to have it, right? And so now you make an impulse buy and you're like, I'm in. I got a raise. It's all good, right? And they'll give you the car. Boom, there you go. Here's your car, $850, $900 a month. You can lease it. And off you go and you're happy. And now you have a $900 payment for 3 years if you leased it. Okay, impulse buy. Why is good credit bad? Because you can impulse buy and get into big trouble. Okay, secondly, possible trouble point, payments pile up, right? You lose track of all the stuff you got. So you've got the car payment, the boat payment, another car payment, the house payment, the payment for the roof, right? Let's see, I bought the furniture over at Levin, and Best Buy, I got the new 110-inch TV. And these are all payments, and you sit down with paper and add them up and you go, holy crap, this is more money than I make, right? That's how you get into trouble. So you've got to make sure you monitor, keep track of this stuff. Listen, I know this is like basic, but listen, we're all human and we just miss many times the answers right in front of us. It's the most basic thing and we don't even see it because we're looking for something more complex, okay? So I would tell you, use a spreadsheet, a simple Excel spreadsheet, man, and just put your stuff down and just look at it so you know what you got. Don't play it in the air, because if you play it in the air, some of it can float away and all of a sudden it will bite you. It will come back and bite you, okay? College cards, right? That's another thing. A lot of times they come at you and when you're going to college and they bring you all these cards. These banks want you to, here, use this card. We'll give you this card. And you get these cards and now you get into this debt, and they may have a pushed out interest rate where you don't have it for a while. And then all of a sudden, boom, now you have interest and you got this big debt on your card and you're eating on it and you're buying stuff on it. These are very real things. You got to be careful. Just because they give it to you doesn't mean you should take it, okay? Because these college cards are bad deals, because you come out of college and now you come out with debt on a card and you come out with your loans and now you try and get the job and you're not making the big money yet. It can put you behind at the beginning and you really don't want that, okay? Paying late is another bomb, right? Make sure, a lot of people have bad credit scores just because they don't pay attention. Just make sure you pay attention and pay your bills on time. That's it. You know, with all the stuff we have around us, with our phones, alarms and sounds and everything around us, you know, ways for us to remember, you know, just pay your bills on time, and your credit score. Remember, it's 35% just paying on time of the weight, right? And the other piece that can get us, guys, is the interest rates. If you take credit and the interest on it is really high to get it, it can come back and really hurt you in the long run. It will cost you so much more money. Okay. These buy now, pay later cards are good gigs. Okay. There's sometimes maybe for you as college students, if you've got some debt, where these buy now, pay later cards or plans or introductory type things could be of help to you. If you can go buy a brand new living room set that's $5,000 for your home, and they'll give you 36 months, same as cash, and you don't have to pay but a very minimal amount of money on it every month for 36 months. As long as you pay the $5,000 off, they're not charging you any interest at all. They're giving you $5,000 to use for 3 years. As long as you make sure you pay that back within the 3 years, that's a great deal. If you have good credit, you can do that kind of stuff. Okay. But don't get screwed by not paying it back. Because I promise you, you give it once, you'll remember it. Because they will pile the interest on you, and you'll be stuck paying $8,000 or $9,000 for that living room set instead of $5,000. Okay. I want to give you an example, and as we wind down this episode, just to show you how this plays out. So if I have $5,000 that somebody lends me, say I've got $5,000 on a credit card, and it's a 19.99% interest rate. Okay. My payment just on that card to cover the money, just for the pleasure of the bank giving me the $5,000, okay, is $83 every month, almost $1,000 a year that I'm paying. If I just paid the interest, after a year, I would have paid $1,000 almost, and I would still owe $5,000. Okay, that helps you understand a little bit about how this game works, right? Think about that interest rate. Some of these guys are charging 29, 30% interest. Okay, that it's really almost illegal that they should be allowed to do that, but they are. And interest rates are up right now on everything. So let me give you some recommendations before we go on good ways to use credit. Okay, good ways to use credit. Consolidate balances. If you screwed up and you have credit cards and you're paying big payments at 19, 20%, 25, 30%, try and apply for a credit card that will let you transfer balances, right? For like 12 months or 18 months. They'll let you take your $5,000 on over here that you're paying so much a month for, and they'll let you put it on their card. They'll issue you a new credit card. They'll let you put it on that card, and they won't charge you any interest for, say, 18 months. So you take your $5,000, you put it over here. So every penny you pay for 18 months on this one knocks down your $5,000. Every penny. There's no interest, right? That's a huge win for you. And as long as you keep good credit, if you don't get it paid off within that 18 months, go get another card and take that one and put it on there for 0% for another 12 months, okay? Use their money free, right? Use their money free to pay off your debt rather than pay all the interest on it, right? That's a positive to consolidating your balances, right? The same as cash 18 months, great thing. If you have the credit, make sure you pay it off, okay? Home equity lines, for those of you who have homes, right? Or you are thinking about getting a home, right? As long as you have equity in your home, right? And you have the ability to say, hey, look, I have a $400,000 home or let's say $300,000 home, and I own 150 of it. So I paid 150 down. So my bank loan is 150 grand. And the bank says, hey, I'll give you a home equity line of credit for $100,000 because you own 150 of it already, and you're paying me the other 150. So I'll give you an open line. It's like an open credit card for $100,000 that you can use for home improvements, or you want to buy a car or whatever. You're going to pay an interest rate, but typically, if you're borrowing it from your home, it's less than if you were going out and borrowing it from somebody outside. Okay. So those are also good. Then there's a home equity line of credit, which means that you get an amount and you can use it and then you pay interest on it, right? You pay a payment every month. Or you can get what's called a home equity loan. That's different than a line of credit. That's where you say, I want a loan on my house for 80 grand. I want to take $80,000 out of what I own in my house, and I want to be a 10-year loan. And so my payment is this much every month for 10 years, and I pay the loan off. So you have to take all the money. Okay, it's not like a line of credit where it sits there and you use what you want. On a loan, you take all the money and do what you need to do. Okay, so let me just see what else I want to talk about. I think that's pretty much it. So some good products to explore. I wanted to give you some good information before we close out. So if you want to look at travel, right? There are some products in the marketplace. You can use products. When I say products, they're credit cards offered by all kinds of banks, okay? And there are different kinds of them. Some of them offer miles if you travel. Some of them give you cash back right into your account. Some of them give you points toward free hotel stays. Some of them give you gas. So here's some information that's real and relevant right now that could be helpful to you. On a travel basis, Chase Sapphire Reserve card, Chase Sapphire Reserve, if you spend $5,000 on that card within the first 3 months with travel and food, you begin to get very significant benefits and points from Chase, right? There's incentive there. So that's one of the top rated travel cards right now, the Chase Sapphire Reserve. And you use that to buy all kinds of different things, okay? And you're not trying to just buy it and have the bill. You want to pay it off. So you're using it as a living expense, but you're gaining on the other side of it, all right? The other one that I would tell you about is American Express Hilton Honors Card. So American Express has cut a deal with Hilton, and they basically say, hey, if you use our card throughout the month to buy clothes or gas or food or groceries, we give you so many points toward a stay at a Hilton hotel property for every dollar you spend, all right? So if you're going to spend the money and you're disciplined enough to pay it off every month, which you have to be, or you can get yourself into trouble, okay? That's a really good opportunity to get free hotel rooms just because you're using money that you are going to spend anyway on their card, okay? Then as far as a cash back card, which is you get paid so much back for every dollar you spend. It's that simple. Chase Freedom Unlimited card is the top one that's out there right now. They pay you back 5% on the travel you book, 3% on dining and drugstores, and a 1.5% on anything else outside of that. So if you travel and you charge that card for your airline fares, if your airline fares are $5,000 or are $1,000, right? If they're $1,000, 10% would be 100. So they're going to give you $50 in cash back because you just used their card to charge $1,000 worth of airline travel. So that's a high rated one right now. Chase Freedom Unlimited. These came up when I was searching. Also, Citi has one called Citi Double Cash. And what they do is they'll pay you 2% flat. So anything you charge on their card, they give you 2% of that amount back in cash, okay? Balance transfers, some of those cards that are really good right now, Wells Fargo Reflect is a card that's out there. They'll give you up to 0% for 21 months. So you can move money over from another card of high interest or some other debt and put it on this card, and they'll not charge you interest for 21 months. So that's Wells Fargo Reflect. Also, Citi Simplicity card has a 21-month card as well. And then a Credit Builder Starter card is a Chase Freedom Rise card or a Capital One Quicksilver card. Those are cards that are specific to help beginning to use credit and build credit, okay? So we have talked about a lot of stuff in the past 2 episodes. I hope you have taken notes. I hope that you appreciate the information and the amount of effort it took to pull all this together to give it to you. And I believe that it'll be helpful. Hey, I would love to ask you if you would take the time to share and to like and to subscribe to the podcast. Please, I want to ask you to share this. This is information that took hours to put together. And remember, it's a really big deal. Today's word was understanding, the ability for you to really make sense out of all the stuff that we've gathered and pulled up to you, okay? Pick one of these things. Continue to work on it. Go to Credit Karma and join it. Remember, it's such a great tool. It's free for you, right? And we'll have more about finance in the days and episodes to come. The next episode that I'm planning to bring to you is going to be a very interesting one. It has nothing to do with credit or money. It's called Guys Want, Girls Want, an open, raw discussion from both sides. So the goal is we're going to have a guy here. We're going to have a girl here. They really don't know each other. They're not dating each other. And we're going to talk about some raw stuff that girls don't typically probably tell guys that they're looking for in a relationship with a guy. And the guys are going to share stuff with the girls. We're going to have debate. It's going to be open. And I think it's going to be a really good episode. And I hope that you will plan to come back. Tell your friends about it. And I want to ask you, if you would, tell someone about the podcast again. Please subscribe. Please like the podcast, right? And I want you to remember, until next time, please do something and apply what we've been talking about in the past 2 episodes. Remember, you are a very unique person. There's only one of you. I'm John, and I'm out.